Hi traders, welcome to this week's edition of Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 45 minutes, hopefully. Lots going on, of course. We'll review the main headlines for the markets as we approach a new week, of course. A quieter week really on the calendar, but obviously markets still digesting really all last week's key big risk events, of course, all those central bank meetings, as well as then Friday's non-farm payroll, obviously being a huge shock to the markets, with that blowout 500 plus thousand headline print on that US employment data, but also then wages being quite moderating really, 0.3% on that average hourly earnings month-on-month figure, and the annual figure actually coming down as well. So we'll look at that in more detail for sure. But firstly, yes, we'll look at stocks as we normally do. We'll look at the VIX, which is Wall Street's fear gauge, if you like, and just on one theme that's sort of making a reappearance for us, which is that one about FOMO, so fear of missing out, of course, with this quite surprising rally in risk assets in stocks, now coming under a little bit of pressure, but big gains this year already. And we'll just look at the theme around that, and then look at the technicals, of course, to do with the S&P, the NASDAQ, the Dow, and we'll touch upon the FTSE 100, the UK FTSE 100, which is racing ahead, hit all-time highs on Friday. As I say, we've pulled back from there, but just touch upon the FTSE 100 and a couple of the drivers in that index. Always good to sort of spread our wings, if you like. We looked at the ASX 200, the Australian index last week, as well as obviously always focusing on the US, the major indices there. We'll then run through a review really of the Fed, the FOMC meeting last week, the ECB and the Bank of England. And then we'll look at non-farm payrolls, of course, as well. Just a few graphics on that and some charts just to illustrate that blowout number, the blockbuster headline. And then also that wage growth that we just touched upon. And we'll look at all the currencies to do with those risk events, those central bank meetings. So obviously euro, dollar, sterling against the dollar, cable. We'll look at the DXY chart. And then hopefully we'll have time to touch upon the RBA meeting as well. So they meet overnight tonight, so Tuesday. And we'll look at the Aussie against the dollar, hopefully wrapping up with that. Okay, markets this week, super busy week, as we said, as you should know, really. Calendar much slower now in terms of data and scheduled events for this week. Highlights will be that RBA meeting. We also have Fed Chair Powell's speech tomorrow in the US, talking in Washington at the Economic Club there. So there'll be some focus on that, especially after his comments, of course, in the press conference last Wednesday at the Fed. We also get the postponed German CPI data actually for January out on Thursday. That'll get some headlines. And we also have UK GDP to finish the week on Friday morning, early UK time. As I said, sort of markets really digesting that unbelievably strong US jobs data, US headline data, in fact, on the non-farm payroll really was the kicker. And we've also had this increase in tensions really between the US and China after the US Secretary of State Blinken, he cancelled his trip to China over the discovery of this spy balloon. You may have seen some pictures of this. Kind of, yes, a shame, because obviously the relationship, the West and Beijing, had appeared to be on track for some improvement actually in the first few days, the first month of this year, and especially with China's reopening of the economy also happening. So that is sort of in the background lingering, that just to sort of slight deterioration really in the relationship between US and China, of course. And then near term, probably the biggest market impact so far today, at least, has been reports in the Nikkei about the next Bank of Japan governor. Essentially, the current deputy governor, so Amamiya, has apparently been approached by the government to assume Governor Kuroda's position. I think he will be formally announced in a few weeks' time, but this month especially, and then to take over from Governor Kuroda in April. So the choice of the current deputy governor really that's likely to extend the Bank of Japan's ultra easy monetary policy because he's seen as a continuity candidate who is pretty close to obviously the departing governor. So really interesting news there, and the choice potentially of Amamiya. Essentially that's bullish for bonds, bullish for Japanese government bonds, and then bad really for the yen and for local financial stocks. Ultimately, markets may need to actually recalibrate then their expectations for policy adjustment if Amamiya is confirmed. If you remember the shock December decision to tweak yield curve control policy, that's kind of illustrated the shock waves that any hint of policy change at the Bank of Japan, what that can trigger actually. If you remember then, that sent the yen and Japanese yields soaring really, and treasury yields lower. So really then we potentially need to price in all the bets of that early withdrawal of stimulus. Potentially those wages now need to change and shift if we don't get, or if we get, a delay in the to any policy tweaks, which is generally what the market was supposing with the new governor, and obviously with that move in December that we got. If we just look at the dollar yen chart, you can see, where are we? Dollar yen, you can see, yeah, we're up 0.7% today. I've just pulled the weekly chart here just to show you these long-term Fibonacci levels, and you can see the midway point really of, let's just pull back there, of sort of 2021 low up to last October's high. You can see the midpoint, the 50% level there was 127.26, you can see, and we got down sort of below there, 127.45, so not quite below there actually, and then 127.21. So we did touch below, you can see on this long-term weekly chart of the dollar yen, but then that found support at that halfway point. If I just go into the daily then, I've kept these descending sort of bear channels here. We had this long-term one, and then I've drawn a nearer term one, if you like. It's probably not too clear, hopefully it is, but you can see this nearer term descending bear channel there, sort of tapping quite a few levels there, so quite important really, potentially. And you can see then this break to the upside really on Friday after non-farm payrolls, and then obviously this move up towards the 50-day moving average of 132.64. We've got some near-term fib levels there, which combine with that 50-day moving average. You can see the halfway point of the, let me just get this. Yeah, the halfway point is at 132.70, so potentially that's resistance level above here, and then, as I said, that 50-day moving average at 132.64, that will potentially offer some resistance to this move. But we have broken out, looks like, of that descending bear channel going back to November, so interesting whether we get this push above this next resistance level or not. That's in dollar yen. Okay, just looking at equities as we normally do. We think two interesting things to look at here. One is the VIX. So that is the fear gauge, as I said, Wall Street's fear gauge, it's known as. It tracks investors' expectations of volatility basically over the next 30 days, over the next month. And let me just find that for you, because we have a chart, as we haven't looked at it for a while. So I'm just trying to figure out where we are. It's here. So you can see that this volatility gauge really is well, it's been below its long-term average is around 20, and we've been below there now for the last well, 2 straight weeks really. And that's actually the longest stretch of low volatility since the start of last year. So if we just pull back, if you can see we didn't get this stretch here below sort of 20 or so. This time last year basically was the last time we got that. So very low volatility. And even this is for the next 30 days, but there's a chart for the next 1 year VIX, which tracks expectations basically of the stock market swings over the next year. That touched actually its lowest level since the onset of the pandemic. So it's really interesting how little volatility there is in stock markets, at least. This drop in the VIX generally leads to a lot of funds having to increase their leverage and then add exposure to stocks. So can be seen as a contrarian indicator. Of course, the longer we are down here below 20, that longer term average, then potentially it's very rare we go much lower, 17s, but you can see we don't last too long because the long-term average is around 20. Yes, then if we're using this as a contrarian indicator, then potentially we go higher. And that means increased volatility. That sort of tallies with our other theme that we've just sort of noticed. As I said, we're getting this sort of rebirth of phrases like FOMO, so fear of missing out. If we think the S&P 500 is now up 8% since the start of this year, the tech-heavy NASDAQ, that's rallied by 16% this year. And those indices were down by, the S&P down by a fifth, the NASDAQ down by a third, respectively, last year. And then other risky assets, especially those beaten up for most of last year's sell-off, they're now the best performers. So we think of Bitcoin, that's jumped over 40%. And then Cathie Wood's infamous ARK Innovation Fund, that's dominated by high growth tech stocks. That's up nearly 50%. So certainly there's still a lot of cash on the sidelines after last year's sell-off, of course. And that's kind of created this conundrum, if you like, as funds really, they don't want to miss out on the rally, but the market is kind of behaving as if we're on the other side of a recession that hasn't even happened yet, really. So really interesting time here for stocks, buoyant, exuberant stocks, if you like. And really data is key going forward. And especially we'll touch upon it, but just seeing the labor market, obviously strength, and still this ongoing fight between really the market that we've talked about over the last few weeks, not really believing the Fed, but certainly then the non-farm payroll report really giving a jolt to that idea that we'll get a soft landing and more. Just near term then for stock markets, we can see we just got the S&P 500 here. Near term, yes, US stocks gained for a second straight week. The S&P did fall after the non-farm payrolls fell by 1% or so on Friday, but it added 1.6% over the week. And then the tech-laden NASDAQ, that slipped 1.6%. 1.8% the NASDAQ 100 on Friday, but finished the week 3.3% higher. So essentially, it's kind of a week last week of two halves, really. We had those big central bank meetings raising interest rates to the highest level since 08, actually, since the GFC. But then investors rushed into bonds and equities after officials hinted at that the current cycle of monetary tightening really nearing its end. We also had earnings, obviously, from Apple, Amazon, Alphabet, all showed sales growth softening. And then obviously many companies as well, they've recently announced jobs cuts. And then on the flip side, the second side, we had, as we've said, the monthly job figures. US economy really remaining resilient despite obviously significant monetary tightening over the past year. And that really, as I said, sort of punctured a lot of optimism, or just some optimism, really, we should say, that the Fed will pivot and cut rates later this year. We're going to some of that pricing later as we look at the Fed. But it's this idea of the markets fighting the Fed, markets being confident that inflation would come down quite sharply, and then the risk of a recession, as we said, or a policy mistake even, or a second wave of inflation, really, whether that, it had been a kind of afterthought, but now the sort of job numbers really do introduce some doubt on that thinking. Technically, on the S&P 500, we've highlighted it before, and we note, we highlighted it last week, actually, this crossing of the 50-day moving average, rising above the 200-day moving average. That happened on Thursday, and is a pattern known as a golden cross. You might have read about it, getting some headlines. There's some research since 1950. The S&P 500 has produced, on average, a 12-month return of 10.5% after a golden cross formed, while the overall average annual return since 1950 is 9.1%. That's according to LPL research there. But when a golden cross has appeared as the 200-day moving average is declining, as it is now, then the average 12-month return for the S&P 500, that jumps to 16.8%. So some interesting stats there for you. Just technically then, when we went past that target that we mentioned, the December pivot highs around 4,100, and then we pinpointed the September high at 4119, and then after that, the sort of late August highs at 4,200. So sort of these highs, actually, the late August highs, 4,200, just above there. So we've sort of tapped that area that you can see. And so we kind of thinking that the support will come at the December pivot highs around 4,100. And then, we get back to potentially the 200-day moving average, which is now below 4,000. So interesting times. We couldn't quite get above the late August highs. And then certainly these mid-August highs, if you like, around 4,300 and above. Upside target for bulls if we can hold above sort of 4,100, we think. For the NASDAQ, this is the NASDAQ 100. We did get close to a big fib level. If we just go to the weekly, actually big fib level at 12,947 there. So that's a 38.2 fib level of the sort of pandemic low up to the high, 38.2 at 12,947. So didn't quite get to that. We got to 12,880 last week. So that's still going to offer some resistance, really. Strong resistance, you can see it there. And then if we do pull back, we do have the 200-day moving average there, just below 12,000 at 11,960. That sort of tallies with that mid-December high there at around 12,166. So sort of 12,000 level should offer some support in the NASDAQ 100. Just look at the Dow as well. Always like looking at the Dow. It's obviously lagged the tech-heavy NASDAQ for sure this year. And if, again, we go to the weekly, we can see, actually, interestingly, just pulling out, you can see that candlestick there. That's a doji. So sort of signaling quite a lot of indecision, really. You can see we sort of closed and open. Well, we opened last week and then closed very much a similar level. And sort of bang in the middle of the high and the low from last week. So generally means kind of indecision, and you can see it here on the daily. We're tracking sideways, kind of just above, just below 34,000, but above sort of 33,800 or so. strong resistance still, we think, at 34,281. That goes back to that mid-August high there. And then probably support at the 50-day moving average, tracked a held support over the last few days at least. And that comes in at 33,665 there. That's the 50-day moving average. And then probably next support would be 33,000 or so. That's on the Dow. We said we'd touch on the FTSE very quickly. We can see, we tapped. Let's go to the monthly chart here, and you can see, one sec. That's better, sorry. So you can see all-time high. Yeah, we took out just about last week on Friday. We closed at 7902 on the FTSE 100. That beat the previous peak back here in May 2018. And we've risen over 6% this year on the FTSE. So we actually ended up nearly 1% in last year, 2022. That was actually the best performing developed market index in local currency terms. So the FTSE, I think we all should remember, is dominated by multinational companies. So there's kind of not a lot of drag from the domestic economy, which is obviously heading most likely into recession. Many companies in the FTSE 100, then they book the bulk of their revenues overseas. So certainly when the sterling is suffering, it has suffered obviously since, say, Brexit versus euro versus the dollar, then that helps some of these big dominant multinational companies. And then secondly, the FTSE is heavily exposed then, a lot of these multinationals heavily exposed to oil. So they're oil companies, they're miners, the banks, insurers, utilities. So they kind of lack that those high growth tech names. And you'll see that sort of argument swing sort of circular swings really, because sometimes it's seen as a bad thing, obviously, when high growth tech companies are rip roaring, but at the moment they sort of have struggled. So the vice is really sort of in the past now, and seen as a virtue really, as we get obviously still high inflation, still rising rates, much higher rates than we have had, and those have obviously squeezed tech valuations and pushed investors to potential stores of value. Just an example, say Shell, big oil company, of course, second biggest company on the LSE, on the London Stock Exchange. That was up 43% last year. HSBC, big banking conglomerate, of course, that was up 15% last year on higher interest rates. So interesting, we're sort of tapping those all-time highs, posted new all-time highs, and have just pulled back now. So we have support. We've kind of got it up here, the January 2020 high, 7689. That's probably first support that we see. And certainly you can see if it's a false breakout or not, then yeah, you can see that sort of 7700, 7689, strong support. If we lose that, then we're down back towards back below 7600 and towards sort of moving potentially back into sort of this levels below 7600, 7500. So interesting times for the FTSE for sure. Tapping its all-time high. Okay, next up, let's go to the Fed, of course. Huge meeting last week. And we'll look at the reaction. Yes, so the Fed unanimously decided to raise its policy interest rate, of course, by 25 basis points to 4.5 to 4.75%. That's actually second straight downshift. So you remember we had a 75 basis point hike, a series of those in November, then we moved to 50 in December. And really in its new policy statement, it still commits to future increases of the policy rate. But the reference to the pace, so that's the magnitude of hikes, they changed that by one to mentioning the extent, so the amount of hikes now. And that really indicates that the final steps, we're sort of in those final steps before hitting the peak rate, which will definitely then be 25 basis point moves. The Fed characterized inflation as remaining elevated, but added that it had eased somewhat. And sort of, it was interesting in the space between the release of the statement, which you can see here, and then Chair Powell's press conference. We can see that front end yield, so that's the 2-year yield, Treasury yield, that closely maps Fed funds futures. That added actually around 5 basis points. And when we also had stocks, they faded sort of moderate selling. They faced moderate selling pressure while euro dollar tried to dive back below 109. And that was really all from the point of view that multiple hikes from the current level imply a higher peak rate than was discounted. But then we had Powell, and kind of, strange press conference, really. He's kind of known for his pragmatic communication style. But he lacked his sort of usual fire to talk up the market to the Fed's projected rate path, which was he was probably expected to do. Some actually referring to it as kind of capitulation, really, but it sort of one phrase really summed it up, really, when he said certainty is just not appropriate here. So I'm not going to try to persuade people to have a different forecast, but our forecast is that we'll take some time and some patience, and that we'll need to keep rates higher for longer. So he was kind of more, relaxed, and really a few things stood out. Firstly, he sort of did seem to prepare markets for a potential change in the dot plot going forwards, so to making them really sort of more data dependent. After seeing reports of hiring, inflation activity before that next meeting. And that really throws the question as to whether the Fed then will lower the expected peak in the tightening cycle, potentially. And then secondly, on inflation, he mentioned for the first time the disinflationary process had started. So that was a big statement by him. And then thirdly, when it comes to the unwanted easing of financial conditions since the previous meeting, so the financial conditions, that means, or the easing means a weaker dollar, it means lower bond yields, and it means stronger stock markets. So he kind of refused to push back against that softening, and said really that the Fed's focus is not on short-term moves. So really interesting few points to note there. He also then said about a near Goldilocks scenario where inflation can come down while unemployment does not have to rise. So really interesting times. And we can see the reaction really with these 2-year Treasury yields. Just for the record, though, we should qualify, he did stick to some of those hawkish views, really, that the inflation battle is in one. The labour market remains tight. The risk is obviously consequences of underdoing of it are way bigger than ones around staying the course, and that the policy rates may stay restricted for some time to come. But at that time, and we think it's kind of worth emphasizing this because obviously things have changed slightly with the non-farm payroll, but at the time, markets obviously gave outsized weight to those dovish twists during the Q&A, and that sparked that reaction that we can see here, where US yields really tanked by sort of 9 to 11 basis points. You can see here from above 4.2% down to 4.1 or so. And even rate cuts were priced in a little bit more. So I think the December 2023 contract, that was cut by 10 basis points, and now going from sort of 4.5% to 4.4%. And then stocks obviously turned those losses, which it had seen before the press conference, with the NASDAQ rallying around 2% or so. And then the dollar sailing off, of course, with euro dollar actually trading above 110 for the first time since April of last year. So that was the reaction, obviously, after the Fed meeting. Positioning also interesting for probably further dollar declines at the time, because it was struggling to make sort of push to new lows, really. So we can see the Treasury action, and then We'll look at the DXY very shortly, but the going forward then in the near term, that was the reaction. I'll just pull up the DXY chart. Actually, you can see here now. So we can see we bounced off really. We got down to, where did we get down to last week? Down to 100.82, and then we've sort of rebounded from there. You can see there, sort of tracking sideways around 102, punch below, and then this sort of rebound, third day now of gains. As I said, going forward, US data quite quiet this week, but Powell speaks on Tuesday. There are also several other Fed speakers this week as well. We did have the Fed's daily speak after the European close on Friday, warning that it's too early to talk about what the Fed will do meeting by meeting and to declare victory or at least a peak in inflation. So really be interesting, and there'll be a lot of focus, I think, on Powell, whether he echoes those sentiments really, and whether as well then he signals a sort of rate protests after the sort of post-Fed market reaction, and then obviously since the non-farm payroll. And really then, is he still relaxed about those loosening of financial conditions? Because he'll certainly have the opportunity to push back against those, which he, of course, didn't do in his press conference on Wednesday. So for the DXY, this is obviously the basket of 6 currencies, euro being the predominant one in this index. You can see then levels above, we've kind of got mid-January highs, sort of 103.29, 103.48. And then we've got this 50-day moving average, the light blue line at 103.63, probably resistance there. We have left in these dotted lines here, which are, if you've been following us for many months, we are left in the March 2020 pandemic high. That's a 102.99 there. So just above there for the minute. But then above here, we've got January 2016 high at 103.82. Just to make that a little bit clearer, you can see, these highs here, which we think are quite important. You can see the spike high there during the pandemic. So we'll offer they did offer some support, and now potentially resistance. You can see here more clearly. Okay, let's now focus on the ECB quickly. Quick review of its meeting last week. If you remember, pretty hawkish expectations most of us had. There was a high bar really to surprise hawkishly, and really the ECB President Lagarde really failed to do that in some ways, in many ways. So the ECB raised rates by 50 basis points to 2.5%. They also committed to another 50 basis point hike in March. But the statement said that at the March meeting, the ECB would evaluate the subsequent path of its monetary policy. And that really sent out a message that the most hawkish G10 central bank, at least currently, may also be looking at stepping down in its pace of rate hikes. Lagarde attempted to stress the longevity of reaching terminal by stating that when the level is reached, rates will need to stay there for a long time. But there was a clear scaling back of hawkish market pricing for this year, at least, with around 25 basis points of tightening taken out. The German 10-year yield, actually, that slumped by 30 basis points. So that posted its biggest, I think, one-day decline since 2011. Interesting times. There was a Reuters sources story out after the meeting, noting that ECB policymakers see at least 2 more rate hikes with an increase of 25 basis points or 50 basis points in May. So potentially that's sort of thrashed those hopes of a May pause for now. We kind of think the market should also really pay attention really to some of Lagarde's comments actually about continuity and consistency. So she reinforced actually, or referenced her Davos comments about tight labor markets, ongoing wage rounds, high core inflation, and the need for fiscal policy to start unwinding measures. She also said that the disinflationary process has not started in the Eurozone. And really, there's an intent really, that, well, there'll be the 50 basis points hike in March, but then that won't constitute the peak for rates. And that will be in March anyway, the month when we get a new set of forecasts, so the pace can be reassessed. So it's interesting. Yes, we think it's really what happens after March, which is probably a key source of disagreement within the ECB, within the Governing Council. Data will be key for sure. And probably then we should expect probably quite a high public debate really ahead of the March meeting about what will happen after that. And that should generate quite a lot of volatility potentially in the near term. And for us, really, still core high inflation is key, and that probably will give the Hawks the upper hand after the 50 basis point hike in March. We've also had a couple of Hawks actually out on the wires already. Holtzman suggesting that, in her view, the risk of over-tightening appears to be dwarfed by the risk of doing too little. Okay, so Eurodollar, we can see after non-farm payrolls, obviously, or sorry, before non-farm payroll, we had that high at 110.32 we mentioned. Didn't get quite, didn't tap, that light grey line, which is the 100-day moving average at 110.59. So that acts as resistance, really. And then we pull back actually below. You can see the halfway point of last year's decline. Actually, is it last year's decline? Yeah, it's actually from 2021, those highs there, down to last year's low, and the halfway point actually is at 109.42. So another level of resistance there, and we've fallen back below that on the weekly, you can see, and then on the daily. Yeah, so next level of support for us is probably this mid-deck high at 107.36. And then below that, you've got the 50-day moving average, that light blue line at 106.85. That's in Eurodollar. But you can see sort of, yeah, we kind of thought that was bullish consolidation, really, sort of, and then a breakout in line with a dominant long-term trend, which is for higher prices. But potentially it's a false break now. And the sort of the longer we track sideways, then there was going to be a break, but yeah, seems to have pulled back with that false break higher. But potentially then we need to stay above that mid-deck high at 107, sort of 36, if we are to then push up above towards 110 again. Okay, also Bank of England, of course, last week. As expected, they raised rates by 50 basis points to 4%. The vote was 7-2, as two of the usual doves really opted to keep rates unchanged. The bank really eased up on its forward guidance, saying that the further policy tightening would be required, but only if there were to be evidence of more persistent inflationary pressures. And preceding all of that, language touting considerable uncertainties in the outlook. The previous language was more direct on the need to continue hiking, but this latest message with preconditions set for another rate hike really suggests that the bank may be pausing. Market pricing then, that moved in a more dovish manner, with the odds of a 25 basis point March hike falling to around 60% from 80%. Pre the announcement, and the chances of a May 25 basis point move, that's gone down to around 10% from around 50% before the Bank of England. Inflation and growth forecasts as well, we mentioned those in our preview. They hinted also at a dovish turn. There was a downgrade to this year's inflation forecast to 4% from 5.25%. And then inflation of just 1.5% next year, so below the Bank of England's target there of 2%. The MPC as well, it was actually less pessimistic on the economy, sees peak unemployment revised down to 5.3% from 6%. And the peak to trough GDP dip, that was revised up actually to -1% from -2.9%. So, big move in sort of gilt in the 10-year gilt yield. That saw a massive 30 basis point drop after the meeting, and also the 2 years moved around 25 basis points. So what does it mean for sterling? Well, we can see Thursday's move again. It looked like it was bullish consolidation, but the longer we went on and we couldn't, we failed to break above that sort of 124.50 area, then it looked like the prices were struggling. You can see Thursday, then we moved lower, sort of tapped the 50-day moving average at 121.90. And then obviously after non-farm payroll, we fell again, tanked again. So that sort of acts as resistance now, 121.90. And we're now into, if we pull up the weekly chart, we've got this halfway point again at 120.52. That should act as some support. And then we've got the 100-day moving average at sort of 119.50. That is on cable. So sterling against the dollar. This week, just on cable, then we have, we mentioned UK GDP. That's out on Friday. Growth expected to have been flat in the fourth quarter, which means the economy will narrowly avoid a technical recession. We've also had, and we'll probably have, we have other MPC speakers out on the wires. We had Mann this morning actually commenting that and giving a lift really to sterling. She suggested that in her view, the bank rate is still more likely to see another hike than a cut or a hold. So watch out for more speakers on the wires this week, which will affect sterling. As we can see, it's given us a lift just towards sort of above that, at least that halfway mark around sort of 120.50 or so. Okay, also just briefly last week, we had non-farm payrolls. Big shock, of course. Above 500,000 new workers added. Really unusual. January's number was sharply higher than had been seen at any point in the decade between actually the financial crisis in 2008 and the onset of the pandemic. And if we look at, I've just got a couple of charts actually. Here are all the numbers, of course. 517,000, massive beats. Above that 189 expected, highest reading since July, 10th straight beat. We also had unemployment 3.4%, so lowest print since May 1969. And then we've sort of got this average, we like to keep that in, sort of 3 months average job gain, still very, very strong, 356,000, obviously bumped up by this great big 517,000 print. We had revisions to the previous 2 months, decent revisions. And really then markets pricing in, around 23 basis points of hikes now for the March meeting. Just on the headline figure, you can see a couple of these charts. The left-hand side one, you can see how punchy that is really compared to if we take out post-pandemic, you can see never really had a 500,000 print until sort of going back to sort of 2011 or so. So you can see how strong that is. And then the right-hand chart really is just one showing how big that print was. 200,000 positive surprise. That's above the highest estimates really these figures are, and you can see again very rare occurrence of that. I think it was the second time the rise in the payrolls had topped the highest estimate by more than 200,000 actually in 25 years. So huge number. Of course, the labour market matters. It matters to the Fed. Evidently, they put the pressure from higher demands from wages at the center of its battle against inflation. So if employment is weakening, then that should be a sign that the rising interest rates, the medicine is working, bringing down price pressures and ready for the start of cuts. So that's obviously not what we get here. And really then we have to work out how the Fed is going to react. And as we say, that speech by Powell will be in focus, but it definitely highlights potentially the Fed being on that higher for longer path with rate hikes again, and again against the current narrative for markets, really. Certainly data points will be key before the next meeting. And it puts really a placeholder that the labour market really continues to run hot and continues to run tight. Of course, there is that little kicker which we mentioned, one part of the report which isn't overheating, which is wages, average hourly earnings when looked at, and this is a chart on a 6-monthly annualized basis, they continue to decline just a little bit. And so really then we can see it's still too high really for the Fed's comfort, and certainly high enough to deter probably rate cuts further out. But also then we have to remember employment numbers, they're essentially backward looking. So they're kind of a classic lagging indicator. So it'll be interesting, yes, what Powell makes of it, what policies make of it. Because just to cover a couple of other bits of data, actually, we had ISM data, manufacturing and services out last week. Manufacturing, new orders, always interesting, good leading indicator, as opposed to that lagging data of the employment data. But new orders point to recession risk in manufacturing. That actually contrasts to the one for services, which came out actually 90 minutes after the non-farm payrolls. And again, said something different again. That survey's run since 1997. And it's only ever once increased by more from month to month. And that was actually during the pandemic. So it kind of suggests a slump in manufacturing, you can see on this chart, but in services, probably a boom actually now. So yeah, interesting data for the Fed to assimilate into its forecasts, into its dot plots, and yeah, policies going forward. Just checking what sorry, I don't have another chart here, but yeah, all shaping up really for yeah, interesting few weeks really, as we get that response from Powell. We'll get other Fed speakers on the wires for sure, and certainly really just putting some doubt into the minds of markets at the moment. Okay, finally, just very briefly, we'll touch on the RBA meeting. That's on Tuesday overnight, so overnight tonight. Expected to rise by another 25 basis points. Let me just pull up the Aussie chart. That takes the cash rate to 3.35%. The bank has already lifted rates at each of its monthly meetings, including 4 50 base hikes from June to September. The RBA then slowed the pace of tightening in October, pivoted to 25 basis points hikes with policy arguably in contractionary territory. But it's really the recent inflation data which has really cemented this 25 basis point hike, and potentially others further out. That showed underlying CPI, so the RBA's preferred core measure actually rose to 6.9%. So much higher than the 6.5% expected by the RBA in its November statement, and also the November print at 6.5%. That is really going the wrong way for policymakers, of course. So really there is more work needs to be done, and the bank probably is expected to leave the door open for more hikes, really keeping intact its guidance that it expected to increase interest rates further over the period ahead. And then looking ahead, interestingly, well, forward-looking indicators, they're softening really. House prices continuing to cool. There's an expected deterioration in household balance sheets. And really then, of course, the full impact of the RBA's rate hikes are still to be felt. Yeah, will be an interesting decision for the RBA. 25 basis points nailed on, but then after that, in fact, there is a small chance, very small chance of no change. But after that, then it's this guidance around what happens and potentially another 25 basis point hike next month as well. For the Aussie dollar, well, that had been roaring higher above 71, you can see. And then we had this big downturn really after non-farm payrolls and obviously a stronger dollar. We've dipped below last week's low, actually 69.83. And now sort of we have the that fib level, the halfway point again of the 2022 declines at 69.15. We're actually below, well, we're bang on that now, aren't we, at 69.13 pretty much. So that may offer some support. We then have the 50-day moving average at 68.55 as probably next support ahead of the RBA meeting overnight tonight. Okay, we've touched on a lot. Thanks for listening in, of course, and we'll speak to you same time next week. Quite a week on the calendar, of course, but Powell's speech to look forward to, as well as just this whole reassessment potentially post non-farm payrolls. Good luck trading out there, and we look forward to speaking to you next time.